Welcome to Duke Fuqua Insights, a podcast where we explore faculty research and the actionable takeaways for business leaders at every level. Many investors grapple with whether active money management is worth the cost. It's a fair question considering most funds underperform the market after fees, but the impact is actually much deeper than that. I'm Tanner Morgan, a recent Fuqua MBA graduate, and my guest today is Professor Simon Gervais. Simon is a financial economist, and his research explores investment behavior and corporate decision-making, including a recent study that goes beyond the usual debates about mutual fund returns. Research shows that active managers may still be good for the economy despite not beating the market. But why? Because they help firms make better investment decisions, which ultimately boosts economic productivity and firm value. Thanks for being here, Professor.
Thank you for having me here.
So let's start with what motivated you to pursue this study. The debate around active versus passive money management has been examined for decades, something we talked about in class. What inspired this specific research?
Actually, it's literally something I talk about in class. It's always in every single course that I've taught in MBA programs, not just at Fuqua, but everywhere else. The second or third slide is always trying to convey why finance is important, and it's about the allocation of capital. So what is the main role of finance? It's about allocating capital efficiently. And what struck me is that when we talk about money management, that function was never discussed. So it's as if these money managers are completely outside the money allocation process. They just get returns from securities, and some are good at identifying the good returns, and some are not as good at doing that. And I thought, well, maybe there's a function that we're not talking about, and then let's try to put the two together. That's kind of the idea.
So tell us a little bit about your model feedback loop, where firms adjust their investment strategies based on stock prices that incorporate information from active managers. What did you find?
Yeah, so the general idea, so the starting point of the paper is to say that money management as an industry as a whole, they possess information that managers may not have. It may be about the direction of the economy, it may be about industries, how competition is gonna happen. So we're not assuming that, obviously, that CEOs don't know anything about their firm. So we're well aware that they know a lot about those. But it is possible that the money managers know something that these CEOs or executives don't know. And so the idea then is that, well, the money managers will trade based on this information, and this will come to affect prices. And of course, the way prices move will inform the CEOs and the executives will inform the firms in general about what these money managers think. And so they may see, well, a good example would be, all right, we announced the merger, our stock went down. Maybe that was a bad idea. So that's kind of the idea that we have in this paper.
So was there a moment during the research process where you realized you were seeing something new or even surprising that challenged the conventional wisdom?
So the main thing that we realized reasonably early on, but that we hadn't fully anticipated, and that created a lot of problems because we didn't know exactly how to model it. But the main idea was the fact that to measure the performance or the contribution of money managers, you cannot just focus on returns. So essentially, you need to think about risk, and you need to think about how investors can absorb that risk and the kind of utility they will get from their positions. So essentially, high returns may be good, but the risk that comes with them needs to be ascertained and measured and incorporated in the measure of the contribution of this activity.
I want to dig a little deeper into the concept of returns. Mm-hmm. So you showed that even if a fund has a negative net return, investors might still be better off. More broadly, active money managers can improve the economy, is what you're saying. How is that possible?
I think the easiest way to communicate the idea would be the following. So suppose that all investors suppose there are only two industries. Let's call them software and automobile, okay? And investors think that they don't know if automobiles should get 60% of the capital or automobiles should get 40% of the capital, and software the rest of it. So essentially, they're unsure about that. If they're unsure, what are they going to do? They're going to go in the middle, so they're going to do 50-50. So they're going to go and just allocate their capital equally. Now, suppose there's one person in the economy or one group of people. In fact, I'm going to call them Tanner for the purpose of this interview. Suppose Tanner knows whether it's 60-40 or 40-60, and suppose that you're willing to take investors' money to do that allocation for them. If you charge us very little money, we're going to be very attracted by that proposition because you're going to do well with our money. So all the investors, let's assume that a large majority of the investors go to you or to the money management industry in general, and we do that. So what happens then? Well, if you think about the way we usually measure performance of money management, we just look at the performance minus the market. Well, you're the entire market at this point. So you're what we call the alpha, which is the extra performance, is exactly zero in that model. Because you charge us fees, your performance after fees is below zero. So you make a negative alpha. Now, are we better off? Well, possibly, because now what you've done is that you've allocated capital in a much more effective way, so the economy is bigger. So even though we get less in terms of returns, we still get a bigger economy and we get more utility out of it. That's the idea.
So even if investors who don't use active managers can benefit from more efficient capital allocation, why would they take on the risk? Is it fair to say that passive investors are maybe even getting a free ride?
Here's the problem, and this is what's very subtle in the model, and this is kind of what the essentially the paper points out, is that essentially passive investing is going to be a bit late to the game. So in the example I gave you, I go 50-50 because I don't know. So if I give you my money, now suddenly I can adjust when software becomes more productive, my position is going to adjust properly. So that's kind of the idea in that model. The other thing that comes out of this model is if you adopt a pure passive strategy where you say, all right, I'm going to invest in the kind of the broadly diversified set of stocks, what's going to happen without looking? So you just say, I'm going to sit back and relax and just do this, as we often teach in an intro course. But what this is pointing out as a trade-off is that the problem is that some of the companies that will have positive shocks, that will have good information, are going to grow bigger and bigger and going to take bigger and bigger risks. So your risk is not going to adjust. So if you think about your own position, yes, you may benefit from the returns, but you may be hurt by the fact that you're not really adjusting your position because of the risk.
You spoke about getting a smaller slice of a bigger pie, right? That's something you just said.
Yeah.
What's your advice for MBAs on how to think about value creation versus value capture, especially in finance?
Actually, what I loved about this paper is that it kind of brought me back to essentially, obviously our focus in finance is about the efficiency of financial markets and how we can think about those markets. But ultimately, what this pointed out is that there's a labor market as well, and labor markets operate effectively. So in the model, actually, it's not automatic that we will hire you directly. We're only going to hire you if it makes us better off, or at least not worse off. Okay? So essentially, what happens is that the value that you create, you're going to benefit from it. So, and that's kind of the way I relate to your question, is that ultimately what it reminded me of is that the way labor markets operate is that if you create value somewhere, you're going to get compensated for it somehow. And so just like, in fact, an example I use in class is that while there are good plumbers, there are bad plumbers. The good plumbers tend to get more money. And that's kind of the idea of this. And so ultimately, it reminded me that creative MBAs, creative workers in general, will reap the benefits of their creativity.
What does all of this mean for how we evaluate or even regulate active money management? Are the current performance standards or metrics outdated?
And this is kind of where the surprise came in that you mentioned a little bit earlier. So essentially, what I think is missing from the way we look at money management is essentially the impact that activity has on the productivity of the economy. So essentially, the perfect experiment to measure how useful that activity is would be to actually eliminate it for a little while and see how worse off we are. So that we would look at the difference and say, all right, this is by how much we are better off. Obviously, that experiment cannot be implemented, but my hope is that with kind of new techniques, we have what's called a structural model, where we can kind of estimate what would happen in the counterfactual, where we don't have these individual, where we don't have this, or we have this regulation and not that regulation, where we can estimate a little bit what is the value creation of that activity. Now, in fairness, or to be fully transparent, I should say, this model is not quite there yet. So we're just pointing out that yes, there's a little bit of a gap in how we look at the performance of these money managers. And the reason for that gap is that, yes, returns are important, but ultimately utility, or how people handle risk, is also important.
One concept that we speak about in class is indices. So massive index funds like VI or VOO. I think a lot of MBAs find these indices attractive. How does it relate to the active funds that we're discussing, or the active money management?
Yeah, so that's a very interesting question. Actually, not one I had really pondered before, but one could actually think of this model. The thing is, what comes out of this model is also the weights for the different, not just for the different companies, but also the different industries. So essentially, the weights are now, if you will, endogenous, to use kind of economic lingo. Essentially, they depend, how big a company depends on what money management thinks about it, and how big an industry is, they also depends on how kind of the money management industry thinks about it. So ultimately, these indices are not as exogenous as we thought they were. So it's not like, all right, we've got this industry, and we discussed this briefly also in our course, if you remember, because we talked about kind of the worldwide market portfolio, and we see how it has shifted over, or at least we discuss how it has shifted over time. Software, obviously, 40 years ago was a tiny portion of it. Now it's a big portion of it. Obviously, more capital has flown to it. And so that's kind of the idea that I think ultimately what we can do is combine what we do, what I do in this paper, and think about index creation that is somewhat more endogenous to that industry.
That's awesome. Well, Professor, looking ahead, do you think that new technologies like AI-driven funds or even alternative data change the role of active managers? Or does it just give them new tools?
I think it's mainly new tools, but I will say the following. I think these are new tools that will probably benefit active money management more than passive money management. So I think that technology, if I think back going from the 80s through to the 21st century, was mainly about the use of technology and kind of setting up trading. And that benefited a lot the index funds, because they can automate how they'll trade, they can aggregate, they can cross trades within the fund. Now we've got exchange traded funds, and so those are clearly very relying on technology. But this is kind of what I would call old style technology. This is just about computing power, whereas this is more about, well, let's think about what we feed to these AI engines, and let's think about what comes out of them to try to gain some advantage. I don't see passive investors benefiting from that very much. More than that, the fees that we incur to invest in passive funds are so small that it's hard to see that they're going to get a lot better going forward. Whereas for for active money management, well, this gives them, like as you said, new tools that they can use to kind of generate, or at least identify information that may be ignored by firms, and that can be incorporated in the allocation of capital. At the same time, I will say the following: it also makes it easier for individual investors to compete a little bit. The difference, I think, and that's what's going to distinguish good from bad investors, is what you feed these engines. It's not enough to just say, give me the good returns. It's going to be about, all right, here's what I think is going on. Let's think about this, and then understanding the output.
Sounds like everyone should take your course.
Hopefully.
Well, Professor, thank you so much for joining me today.
Thank you, Tanner. I really appreciate it.
Duke Fuqua Insights is produced by the Fuqua School of Business at Duke University. You can learn more at fuqua.duke.edu/podcast.